Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Having spent close to 2 decades researching stocks, there are a few thumb rules that I hold very close to my heart. I try not to violate or break them no matter what the temptation. Now, one of these thumb rules is to have an upper limit while assigning a P multiple to a stock. This P limit for me is a multiple of 35x to 40x. Yes, that's correct. The maximum P multiple that I am willing to assign to a stock is not more than 35 times to 40 times. Now, should I come across any stock that's trading at a significantly higher P multiple than 40x, it gets immediately rejected, irrespective of its quality or growth prospects. I hope you remember the famous advice of Ben Graham that you should make Mr. Market your servant and not your guide. Mr. Market or the stock market is there to serve you and not guide you. Therefore, by insisting on a fixed upper limit, you are making Mr. Market your servant. I am asking him to serve me only those stocks that are available at a PE of 40x or lower. If it does not have enough good quality stocks fulfilling this condition, I simply ask him to leave and come another day. Now, let me tell you that a majority of the investors do not follow this advice. They don't have a fixed upper limit for buying and rejecting stocks. In fact, if Mr. Market tempts them to buy a stock at a PE of 100x by creating some nice stories around it, they are more than willing to oblige. In fact, they are making Mr. Market their guide and not their servant. Stock market history suggests that buying a stock at a PE of 100x leaves very little room for error. A lot of growth expectations are built into a stock that's trading at a PE of more than 100x. And even a slight delay or mistake in meeting those expectations, and the stock can come crashing down. Hence, it is always better to make Mr. Market your servant and always insist on a stock where there aren't a lot of growth expectations built into the PE multiple. This way, even if the growth comes slightly lower than expected, there is not a lot of damage done to the stock price. This thumb rule of having a fixed upper limit has helped me enormously over the years. It has helped me stay away from highly expensive stocks, a major source of wealth destruction in the stock market. Now, talking of high PE multiples, there is a stock that has done well despite consistently trading at a PE multiple of more than 100 times for many years now. Trent Limited, which is a part of the retail venture of the Tata Group, has had a phenomenal run in the stock over the last few years. The stock is a massive 47 bagger over the last 10 years and an equally impressive 11 bagger over the last 5 years. Yes, that's right. Trent Limited has multiplied invested money by 47 times and 11 times over the last 10-year and 5-year period respectively. Now, do you know what was the PE multiple of Trent Limited both 5 as well as 10 years ago? Well, a little less than 10 years ago, Trent Limited was priced at an extremely high PE multiple on a consolidated basis of close to 140x. Yes, no extra zeros added. The P multiple was indeed 140x 10 years ago. It's the same story for the 5-year period also. The stock was trading at a consolidated P multiple of close to 140 times 5 years ago as well. And do you know what is the P multiple right now? A whopping 183x. Therefore, Trent Limited trades at a P multiple of 183 times even today. As a matter of fact, there hasn't been a single day in the last 10 years or so where the stock has traded significantly below a P multiple of 100 times. The lowest it has gone to was a P multiple of 97 times back in June 2017. Other than this small dip below 100x, the stock has consistently traded at a P multiple of more than 100 times over this entire 10-year period. Even during the COVID crash of March 2020, the P multiple stayed significantly higher than 100 times. Now you see, the markets may run on emotions and sentiments in the short term, but in the long term, it is the growth and fundamentals that matter. In other words, a lot of stocks can trade at high PE multiples for a year or two, driven by bullish sentiments around them. However, to sustain those high PE multiples for as long as 10 years requires something special. It requires consistent growth and it requires management intelligence, energy, and integrity. Now, it won't be wrong to say that Trent Limited had displayed all these qualities in spades. The management has done a great job of growing the consolidated net profit from a loss of rupees 19 crores in FY14 to a profit of a whopping rupees 1500 crores in FY24. The top line has also grown by 6 times during the same period. Almost all this growth has come without putting any pressure on the balance sheet. The company has had negligible debt all these years. Put differently, the company has grown almost entirely through internal accruals or internal cash generation. Now, Trent Limited also has a solid competitive advantage in the form of deriving a bulk of its revenues through its own private labels. You see, private labels not only ensure high profit margins, but they also give you a better control over the supply chain and lead to massive savings on the working capital front. And the company has milked both these advantages to some great results. Hence, in a nutshell, I like what the company has done historically, and I also like the aggressive expansion plans that it has rolled out. What I don't like, though, are the extremely high valuation multiples which have remained consistently higher than 100 times. In fact, the P multiple is now touching the 200x mark. So what do you do when you like the company and you like the management quality but are not comfortable with the valuations? Well, there are two options in front of you. You either accept the sad reality that this is the sacrifice that you have to make for being disciplined and staying within your circle of competence and simply move on. Or you can carve out a small 5% to 10% of your portfolio for making investments in stocks like Trent Limited, which do not exactly qualify as investments but are more of the speculative type. You see, speculation is not bad as long as you know that you are speculating and are not doing with a large percentage of your portfolio. The danger arises when you don't know that you are speculating and have taken large exposure to it. Therefore, Trent Limited is not an investment for me based on my rule of having an upper limit for all my stocks. It can be considered as speculation as long as I know what I am doing and allocating only a small percentage of the overall corpus to speculation. What do you think? Where does Trent Limited fit in your scheme of things? Is it an investment or a speculation or neither of these? Let me know what you think. This brings me to the end of this video. I'll again see you in the next session. Goodbye and happy investing.